In venture capital, success isn't measured by how many investments a fund makes or how exciting the startups in its portfolio seem. Success is measured in returns, specifically, how much money is generated for limited partners over the life of the fund. However, venture investing operates on extended timelines, often taking 10 years or more before the complete financial picture becomes clear. Unlike public markets, where performance is tracked daily, VC funds rely on specialized metrics to assess if they are on course to deliver substantial returns. This is where 5 key metrics come into play: the internal rate of return, or IRR, the total value to paid-in capital, that is TVPI, the distributions to paid-in capital, briefly DPI, the residual value to paid-in capital, or RVPI, and finally the multiple on invested capital, that is MOIC. Together, these metrics provide a comprehensive picture of a fund's financial health, showing both realized gains, potential future value, and the total multiple generated on invested capital. IRR is one of the most commonly referenced performance metrics in venture capital because it accounts for both the size and timing of cash flows. Unlike simple return multiples, IRR reflects how quickly capital is deployed and returned, the compounding effect of early exits, and the time value of money. Put simply, IRR tells limited partners how efficiently a fund is growing their capital on an annual basis. To calculate IRR, you consider all cash flows, both capital invested into the fund and distributions returned to investors. The IRR is the discount rate that sets the net present value, the NPV, of these cash flows to zero. In essence, it reflects the annualized growth rate of the invested capital, factoring in exactly when money was invested and when it was returned. For example, an IRR of 20% means the fund generates a 20% annualized return on invested capital. Naturally, a higher IRR generally indicates better fund performance. However, IRR can be misleading in the early years of a fund's life. A single, highly valued, but still unrealized investment can temporarily inflate the IRR. That's why it's important to interpret IRR in the context of the fund's maturity and to compare it with industry benchmarks. Top-performing venture funds often target IRRs in the 25 to 35% range. Some exceptional funds, especially those with early, high-multiple exits, have historically delivered IRRs of 50% or more. TVPI is a key performance metric in venture capital that reflects the total value a fund has generated relative to the capital contributed by limited partners. It offers a straightforward snapshot of both realized gains, distributions, and unrealized value, current portfolio holdings. In simple terms, TVPI shows how much value has been created for every dollar invested by LPs. To calculate TVPI, you sum the fund's cumulative distributions, the cash returned to investors, and the net asset value, the NAV, of the remaining portfolio, then divide that total by the paid-in capital. The capital LPs have invested. For example, a TVPI of 2.0x means that for every $1 invested, the fund has generated $2 in total value. A TVPI below 1.0x suggests the fund has not yet returned capital equal to what was invested. Unlike IRR, TVPI does not account for the timing of returns. Two funds might both report a TVPI of 2.0x, but the one that reaches this multiple in 5 years is generally seen as more efficient and higher performing than one that takes 15. Still, TVPI remains a critical metric for evaluating a fund's long-term value creation, especially as it combines both realized and unrealized performance into a single, intuitive figure. DPI measures how much actual cash has been returned to limited partners relative to the capital they invested. While IRR and TVPI reflect potential or total value, including unrealized gains, DPI focuses solely on realized returns, making it one of the most tangible indicators of a fund's performance. This metric is especially important in venture capital, which is an illiquid asset class. High paper valuations can look impressive, but they mean little if LPs don't receive their money back. DPI shows what has actually been delivered, not just what might be. DPI is calculated by dividing the total cash distributed to LPs by the total capital they committed to the fund. A DPI of 1.0x means the fund has returned exactly what was invested, effectively breaking even before fees and carry. A DPI of 2.0x means LPs have received double their original investment in cash. When a fund achieves a DPI of 3.0x or more, it indicates strong liquidity and typically places the fund among the top performers in the market. For LPs, DPI is often the most important metric because their ultimate goal is not just to see high valuations on paper, but to realize actual, tangible returns from their investments. RVPI is essentially the flip side of DPI. It measures the unrealized portion of a fund's value, the capital still tied up in portfolio companies that have not yet exited. This makes RVPI a valuable metric for evaluating the future return potential of a fund. To calculate RVPI, you divide the current estimated value of all remaining unrealized investments by the total capital invested by LPs. For example, an RVPI of 1.5x means that the unsold or unexited portfolio companies are currently valued at 1.5 times the LP's original investment. RVPI is particularly useful during the early and mid stages of a fund's life, when few distributions have occurred and most of the value is still unrealized. A rising RVPI can indicate that the portfolio is increasing in value, while a flat or declining RVPI may signal potential issues. However, since RVPI is based on estimated valuations, often influenced by market sentiment, funding rounds, or internal models, it should be interpreted with caution and always in combination with more concrete metrics like DPI. MOIC is one of the most straightforward metrics in venture capital. It tells you how many times over the invested capital has grown. MOIC includes both realized returns, the cash distributed, and the current value of unrealized investments, making it conceptually similar to TVPI. To calculate MOIC, you divide the total value generated, combining all distributions and the current value of remaining holdings, by the total capital invested. For instance, a MOIC of 3.0x means the fund has tripled its original investment. Unlike IRR, MOIC does not account for the time it took to generate returns. And unlike DPI, it includes unrealized gains. This makes MOIC a clear and simple snapshot of total return, especially useful for quickly comparing fund managers or investment strategies. However, just like TVPI, MOIC's true significance emerges only when considered alongside other metrics, particularly those that reflect timing and liquidity, such as IRR and DPI. Each of these 5 metrics tells a different part of the story, but none of them alone is sufficient to fully assess a fund's performance. In the early years of a fund, IRR, TVPI, and RVPI are the most relevant. IRR signals the trajectory and pace of value creation, TVPI reflects the total value being built, and RVPI offers insight into the potential upside still locked in the portfolio. A promising fund in this phase typically shows a strong IRR, a steadily rising TVPI, and an RVPI that suggests significant unrealized value. As the fund enters its middle years and starts realizing exits, DPI becomes more important. IRR may stabilize, TVPI should continue to increase, and RVPI should gradually decline as positions are exited and value is converted into cash. A growing DPI during this stage reassures LPs that liquidity is materializing. By the end of the fund's life cycle, DPI and MOIC take center stage. DPI confirms how much actual cash has been returned to investors, while MOIC provides a final snapshot of total value created, regardless of timing. A fund with a high TVPI but low DPI may still be heavily illiquid and exposed to risk. In contrast, a fund with strong DPI and MOIC has delivered real, tangible success. Venture capital funds are typically benchmarked against others of similar size, stage, and geographic focus. While performance can vary widely, there are generally accepted benchmarks that help investors evaluate fund outcomes. Top quartile venture funds often achieve IRRs between 25% and 35%, TVPI of 3.0x or higher, DPI of at least 2.0x, and MOIC above 3.0x. Their RVPI during the fund's midlife usually reflects strong unrealized potential. These funds consistently outperform their peers and are the most attractive to limited partners. Mediocre funds tend to deliver IRRs in the 10 to 15% range, TVPI between 1.5x and 2.0x, DPI below 1.5x, and MOC around 2.0x. While they may return some capital, they often fail to generate excitement or long-term LP loyalty. Underperforming funds typically report IRRs below 10%, TVPI under 1.5x, and DPI below 1.0x, meaning they likely haven't even returned the capital invested. For LPs, these represent poor-performing and high-risk investments. For limited partners, the goal is to consistently allocate capital to top quartile funds, those that demonstrate strong and sustained performance, with TVPI exceeding 3.0x and DPI above 2.0x, offering the most compelling long-term returns. For venture capitalists, managing a fund isn't just about picking great startups, it's about delivering strong financial returns to investors. A fund with a standout portfolio but weak DPI is not considered a success. On the other hand, a fund with a moderate IRR but strong DPI may be seen as a top performer because it has actually returned cash to LPs, which is the ultimate goal in venture investing. Long-term success in venture capital depends on balancing all 5 core metrics over the life of the fund. Maximizing IRR early on requires smart capital deployment and early wins. Maintaining a high TVPI and MOC calls for strategic follow-on investments and well-timed exits. A strong RVPI indicates future upside, while consistent, growing DPI proves real-world traction and builds credibility with LPs. Because in venture capital, paper returns may look great in a pitch deck, but it's DPI that truly matters. The funds that master this balance don't just survive, they raise larger funds, attract top-tier LPs, and build a lasting reputation in the industry.